Hello, everyone. It's good to see everyone. We've got an all-star LP panel here. We determined we have 46 years of experience of looking at fund docs, fund presentations, pitch decks. I think some of us have looked at 1,000 a year. So there's a wealth of knowledge. Hit us up after if you're an emerging manager or even a regular GP. We're always happy to give some advice and thoughts, to propel your business. We have OCIOs represented here, and we also have fund of funds, and we have clientele base that ranges from ultra high net worth individuals to sovereign wealth nations and all in between. So we'll start ladies first. Nancy, what do you look for in a GP? And not just an emerging manager. What about a GP?
Thanks, Erik. Good to see you folks. All right, I've been involved in selecting managers for 20 years. I'm also the co-founder of an investment management company, so my heart goes out to that emerging manager because I've been there. One thing on our mind when we're meeting, can I say an emerging manager?
You can.
Okay,
great. Take it wherever you want. Let's go.
We love two is better than one. If you're in a partnership with someone, I think you have that internal reality check. You've got that person to provide a challenge. I hope you have a 1 + 1 = 3 type of environment. I think we like the team from Slauson, Austin and AJ. They can make each other better. And I think if you have two people at the helm challenging one another, I think that could bode well for your future. A second thing that we look for, if you're emerging, what's your long-term vision? You're going to get started, but you're in a marriage if you're going to be in the private equity venture capital space. You're going to be looking after someone's money for 10 years, a dozen years. So being able to articulate not only your day one vision, but your long-term vision, how you're going to strengthen and grow over time. These guys are much more savvy on venture than I am. I'm more of a multi-asset class thinker, so I'm not going to get into venture in particular. But one thing that our organization is really focused on, your operating infrastructure. Are you investing in that? You have so many choices today with outsourced solutions. I see Carta as a sponsor here right today. So you can outsource, you can insource, but we want the manager to be making a big investment in their operating infrastructure and not shortchanging it. So hope that gives you a flavor.
No,
Those
that's
are three
great.
things on our
Nat,
mind.
anything to add to that?
That was great. I mean, a story that is going to resonate right off the bat. We see literally hundreds of pitch decks every year. My team will underwrite 2 or 3 new venture managers every year. So just understanding how high the bar is and how buttoned up you have to be going into a first meeting so that we can understand the value proposition right off the bat and get into some more substantive issues. I think that's probably number one for us.
And the only thing I'd like to add is I don't think anybody looks at anything different in an emerging manager that we wouldn't look at in an established manager. It's team, strategy, track record, terms, right? We look at all managers. I don't care if it's a buyout or what, but in an emerging manager situation, there's a lot of things that we know are yet to be determined. How long has that team been together? It's a marriage amongst themselves. The track record might not be baked as yet. So we not necessarily drop the bar, but we don't have to have everything all buttoned up, and that's okay. Be honest with the LPs you're talking to. You don't have to have everything perfect. We know you'll get there, and actually, we invest in your high management fees to help you get there and invest in that business. What are some of the first things, Kevin, I'll direct it to you, that you think a new emerging GP should put together or put in place as they're going forward or think about?
Well, I think Nancy said it, that the team is important, but operational infrastructure is certainly important. One of the things that we look at Spur Capital is the team. We do want to see at least more than one GP. The basics of having a pitch deck and all those different things are certainly important, but what's most important for us is understanding if that GP has some sort of track record to represent or even demonstrate that they can do what they say they're going to do. So we have invested in emerging managers, but there's always a certain characteristic amongst them that's very similar. They were either a founder themselves or they were an operator of some sort, and they have a demonstrated history of success. Maybe they worked at another VC firm, for example. But we like to see that because in today's environment where there are so many people raising capital, it's kind of hard to decipher how do you select the right fund managers. So those are some of the things that we look for characteristically. And whenever we've pinpointed that and identified that and actually acted on that, it's worked out in our favor.
Anyone else? Nancy?
We had such a great conversation about track record in our preparation for today. If you're an emerging manager and you can port your track record and demonstrate that to your investors, that's great. That says something about the relationship that you had with the place that you just left. But if you can't do that, I think you do need to bring a lot of ingenuity into demoing your track record. So I'll give you an example of something that we saw recently. An emerging manager, but they're established, but they're a first-time team spinning out. They designated across their managers that someone like Erik, who sees a lot of managers, became like a specialist in their track record and did all the research. And then it was like, hey, if you're another investor, you can talk to, I'm just using you as a case study, Erik. You can chat with Erik.
We've been there.
Because he's on a great platform, right? And he can credentialize that track record for and show the research and the backup data that not every, our shop might not be able to do that. So you got to bring ingenuity to it because you got to show your stuff.
And what I try to tell entrepreneurs or people that want to be a venture capitalist, maybe they're an angel investor, or even if you're a junior at a firm, put a little memo together about every deal you've worked on and every time there was a round of financing. What it was, pre-money valuation, why you did it, how it's sourced to you. So you have some sort of track record. When it comes time that you have to put it together, it's already made, right? Because that's a lot of work to go back and try to piece that together so us as LPs can take a look at the track record. There's other simple things like utilizing PitchBook or Capital IQ or Bloomberg. Use public information if you weren't able to port your track record with you. Use as much that you can to put it together so you serve it on a silver platter so the LPs don't have to do as much work. There's some LPs that won't do much work, right? And so the more you can help them do their job, the easier it's going to be for your fundraising endeavor. It takes time. It's not easy, but you have to put in the work.
I might, Erik, if you don't mind, I might add the quantitative side of the stuff is very important where it's possible, but to the extent a GP will not let a departing partner port their track record, there can be more qualitative ways to build that same credibility. So for example, if you can get a very well-known GP at your old firm to come in as an early LP at your new firm, it's not the same as saying these are my deals and we've got 7 people who will speak to each of those, but it gives the same signal.
I think one other small point to add to that is one of our partners at Spur, Paul Gompers, does a tremendous amount of research on this in his role at Harvard. And in his research, he said the success of a venture capital firm comes down to their ability to source and get into good deals. Up to 90% of their returns are based upon that one factor. So if you're looking at a new manager, you want to see that they can clearly demonstrate a consistency and ability to get into really good deals, even if those deals haven't materialized fully. So that's something that we also look for carefully is, can they get into really strong companies?
Yeah, just demonstrate excellence. You don't necessarily have to be have a long track record of being a venture capitalist. You could be the world's chess grand champion and also an Olympic athlete, whatever that might be. Or you had a company and you built it and grew it, and maybe you did a few angel investments. Show us your AngelList track record. We understand that it takes a long time to develop, but there's other things, metrics such as revenue, new rounds of financing that give you some sort of indication that this individual knows how to pick, as well as maybe help those companies. Can we talk a little bit about the value add? Nancy, do you want to cover that?
Value add. I'm looking at Austin here, so I think he's an emerging manager at Slauson & Co. with his partner AJ, but I think a value add, just from where he's sitting, he's connecting capital to new communities where capital wasn't as connected before. So if you're an emerging manager, then you're going to go into some emerging market sectors. I think that's a real, source of value add that's above and beyond. The other thing, when you say value add, you're always thinking about how are you supporting the success of your underlying portfolio companies? What are you doing besides providing the capital? It could come into helping build the talent, helping open doors for customers. You guys are going to be much more savvy on the value add aspects than I am, but just providing the capital is like not enough, right? So you have to be able to demonstrate that you're going to source, then get behind your entrepreneurs, and then accelerate their success. And you can't be all things to all people. So if you're a small manager, you better be picking like the one or two things that you can do, whether it's your network or like your client base, what you can do to accelerate.
And it's not just that you have to show value add. You could have a strategy that you're just a good stock picker, and that's fine. Just demonstrate that some way and show that. Nat, we were talking about sort of just the relationship industry that we're in. Yep. That's pretty important to know. Could you address that?
It's a small world. Limited partners talk to each other. I mean, there are a bunch of us, but 42 years between just the four of us here. 46. Time flies.
Mostly Nat.
Rounded up to 50.
Yeah.
Just started.
Yeah, right. And our jobs are to know who we're backing and know the track record and talk to folks. So whether it's checking out a founder NPS, if you will, or talking to limited partners who might know of GPs that we're currently looking at, we're going to do the homework. So recognize that when you're having this conversation, because we'll talk by the time they're done doing their work. And just I guess that's part of the longer term perspective that you need to have to be successful. I was joking with one of our VC managers last quarter. They've got a 2001 vintage fund with one asset left. Sell this thing. I told them that fund is about to be legally able to drink. Like, let's exit it. But it's
because they're still drawing fees. Why?
They're not. Sell? But I mean, you're going to be in it for 10 plus years, 21 years in this ridiculous case. And so just treat people accordingly.
I mean, one last comment about the value add. I think it's like a really good question, because we are going to do our due diligence, and through our due diligence, we can see, we'll call the entrepreneurs and ask them, hey, what is this GP actually doing for you? And they are often very honest about what the value add actually is. So I think that as an emerging manager, just any manager really, to your point, Erik, we're not going to sacrifice our process because it's an emerging manager. We want to see that these certain things are in place, but those reference calls are very revealing, and we will not invest unless we've done a thorough reference check on any manager. But through that process, we can see what is the value add, how's this GP sitting, what are they doing on your board? Are they introducing you to new investors? Are they helping you with recruiting? Are you helping you with operations? I mean, a lot of different things that the GP can do, but we get that information from those calls.
And be thoughtful when you're telling your pitch, because we will verify, right? And I am going through PitchBook as somebody's given their presentation. I'm looking at all the GPs that have co-invested with you, your main investments, who those co-investors are. If I see that CEO here at the Upfront Summit, I'll ask them, how's General Catalyst treating you? How's Tiger treating you? How's Bonfire treating you? And I get it. I know. No, he's doing a great job. But and he's texting right now. He should be full attention on one of his favorite LPs. Shame on him. I just took a note of that.
Erik, we talked about this a little bit, but one of the players in our ecosystem who might be a little overzealous to try to demonstrate value add, do you want to share some thoughts on emerging managers interacting with attorneys?
Oh, okay. All right, here we go. So, you got to outsource some things and reach out to other people. There's few law firms that do fund creation. Make sure the attorney that you have that is going to write your fund docs does do fund creation and not just corporate, right? There's a lot of things that are going on besides just pushing fees, terms, and conditions, which are, not good when you're first trying to get to a fund, an LP, and get access, because there's some LPs that'll just turn it away. This group doesn't have a track record. They're charging premium fees, terms, and conditions. You're not even going to get to meet that LP. And I think the law firms are recommending that you come from an area of strength, or you just ask for something high and you negotiate low. There you're starting a partnership already, trying to figure out what you can get away with. Just have a normal, simple fees, terms, and conditions, and get this fundraising done quickly and get on with your business. When you prove yourself, start charging at a premium. We're fine with that. Also, vesting schedules. What I've seen on vesting schedules, which is insane to me right now, is that either they're omitted from the documents or they're 2 and 4 years, and that's usually the corporate attorney that's putting that vesting schedule because he doesn't know the difference between corporate and stock options at a startup versus a fund. That's a 10-year vehicle. None of them end in 10 years. I want to know you're committed for 10 years on your vesting schedule. And by the way, what happens when one of your partners who has a 2-year vest walks away and decides they don't want to be with you early on? Now half of your carry is going to someone who's doing no work for 10 years in your fund. That causes problems. I've seen some of the best funds fall apart because of that. So I can go on, but I won't. Just be thoughtful. Ask other GPs, ask other LPs what their thoughts are, and just make the decisions for yourself. Don't be pushed into something that's going to burn you later. We'll skip that. But what are some ideas that a GP should do for trying to get to that first close?
I think they just need to be brutally honest about what they're actually doing. I was literally just thinking about, a lot of times me and my colleagues will see a lot of pitch decks where they're saying, hey, we're on fund 2, it's 12 months later and it's a 70% IRR. I'm like, to me, that doesn't really demonstrate anything other than just a buoyant market right now. I want to see that, hey, you have a great sourcing strategy, you have great co-investors, you have great support, your entrepreneur network is really strong. I want to just tell me the truth about what's actually happening and don't try to fluff things up. But the temptation to do that is probably very strong because you probably don't have much else to talk about other than some of those performance metrics that are there. But I think that as experienced investors, we can see kind of through that. So really just be honest and upfront. To me, that's a little bit more attractive than just kind of fluffing up the numbers.
I think when you're getting started, you're the new thing. You should be meeting as many potential investors as you possibly can. Not only thinking about Fund 1, but Fund 2, Fund 3. I think one of my co-panelists here said, always be fundraising.
ABF.
Always be fundraising. We've invested in someone's Fund 3, but we got to know them in Fund 1. And so you want to keep that long-term mindset and meet as many people as you can. I think if you're emerging, but also if you can articulate that long-term vision, I'll come back to fees. I think fees are too high in the industry. And, you're managing money for people's pensions, people's charitable organizations, and the balance of, the fees relative to the beneficiaries, just keep that in mind. And if you're confident in your success, be generous on the fees. We would anticipate you're going to be helping finance your own startup for a little while and paying your team and looking to earn your money a little bit later on down the road. And so bringing that sort of good faith to the partnership would be useful.
On a related point, and Erik, you asked about catalyzing that first close. Once you have a first close and you're doing what you've told your limited partners you're going to do, it gets far easier from there, assuming the market doesn't go completely to crap. So you have to have that first close. You need the capital in to start becoming a VC and start investing. And so there are carrots that you can offer limited partners, whether it's a fee discount to make the first close or preferred co-investment rights. There are little things that you can consider. Placement agents exist, and I'd say they're probably most useful to get that first close. Now, there's some LPs that see that a fund is being represented by a placement agent and just throw it out. But it's something to consider because, again, once you get the dollars in, once you have that close and you can start writing commitments or writing investments from the fund, the flywheel is going to start spinning.
And do you have a champion in the first close? So do you have someone like Nat who's going to take an interest in you and then open some doors for you and, look to get behind your success in a way that can, amplify, above and beyond Nat. I know you do that for certain managers, but you have to earn that trust. But having a champion in the first close that can be influential is so helpful.
So, Erik, I have a question for you in regard to what is an emerging manager. I was just thinking to myself, let's assume that you're a first fund and you raise your next fund and your third fund within a very short period, or you're someone who raised a fund and it reached a certain size over the same period. Is the emerging manager based upon your time or your size of the fund. And I know we asked this when we were talking about our prep, but it's like everyone might have a different definition of an emerging manager. How do you guys think about that at Mercer?
Yeah, for us, I mean, it does vary from client to client. We have so many walks of life from a client perspective, and some have their own interpretation of it. Obviously, it's usually a fund 1 to 3 with a team that's relatively new, and I would say a fund size that is reasonable, right? And not jump into some crazy fund sizes on your fund 3, but just being thoughtful about it. There's not a number. Some people say less than 200 million. There's the institutionality we can understand. We can pattern recognition this pretty quickly. I think all of us were talking about, we can see a pitch deck. We've seen so many. We already know what the story is, and okay, they brought their returns in later. There's issues. They put their returns up front. They're doing very well. The returns are not on the deck. This could be a hairy situation. But we don't have any specific definition. And one thing I'd like to add about the always be fundraising, there's not even just that. Touch base with your LPs in between fundraising. I mean, nothing irritates us more than you're just asking for money, right? There's a couple GPs, I would say, Mark Suster at Upfront and Ira Ehrenpreis from DBL. They are masters at touching base with LPs, new ones potential, and regular ones. Everywhere they travel on the planet, they try to set up meetings just like they do with entrepreneurs or meet their own entrepreneurs. I would suggest every time you're going to see an entrepreneur, try to get a meeting with an LP. So, turnoffs.
I think I said mine.
We need another one. Don't make me talk about it.
I'll go. This is the what not to do. Believe it or not, in 2021, there are still emerging managers who will send a PowerPoint version of their deck. I've seen typos.
Via Gmail.
Yeah. So if here you are.
Typo, that's a killer.
I've seen typos on the first page of a deck. I'm getting heated, and it's not just the bright lights. So when here you are asking for somebody's capital for 20 years and you haven't taken the time to get your domain name, you haven't taken the time to set up your firm email address. I get it. Like if there's urgency and you just spun out and you want to hit the ground with your first close, fine. It takes 30 minutes to set up an email address. And to go into an LP discussion with this sort of shotgun wedding demonstration right off the bat, it's like, what are you doing? Why are you doing this? And frankly, don't waste my time.
How about mail merge carpet bombing of emails at everybody in the firm? Like at our firm, I'm the global head of venture growth equity. It's going to filter back to me. It doesn't help hitting up every single person in the organization. Get it to a couple. Also, do your work before you're going to take the meeting a little bit. It's so easy to look at LinkedIn to see who you're going to be talking to. I have a funny story. I worked at UPS in their strategic venturing group for a while, and someone in their deck had all these corporations that they worked with over the years, and there was the UPS logo on there. And they're like, we work with the strategic investing group, and so who do you work with there? And I'm like, I used to work at UPS, and they started going, John, how do we, who do we know? I mean, they might have wanted to take that logo off their deck if they knew they were going to be talking to someone that had worked there and knows the organization. It's so nice to understand the connections as well. So, if I know that the group is done co-investments with Upfront, and they know that they see that, Greg and I are connected and Greg's on the board or whatever, when they call, they can, introduce that and say, Erik, by the way, I know. Any other tips, hints to get access to you, Kevin? What's the best way to get access to you?
LinkedIn is by far the best way to reach pretty much anyone in this environment. But I guess to your point, I was thinking about some decks in regard to, like, I've seen decks where it's like a solo GP, then they have like 20 advisors on their advisory board. I'm like, are you really talking to all these people? And are these people really engaged? It would be more compelling to see 3 or 4 that really know who you are and that can really vouch for what you're doing, that is a little bit more appealing. But man, there's so many different things that we could talk about in that regard, but I understand there's a limited amount of time. But if anyone's interested in Spur and what we're doing, website or LinkedIn is a great place to start.
I'd say, ask for advice in every client meeting that you have and prospective client. It's an opportunity to learn. There's such a wealth of knowledge. I think utilizing the network, just hearing my co-speakers here talk, when we go to investment, we have an internal investment committee. I'm the co-chair of that committee, but you see a memo, the first thing on that memo is the process and all the people that were spoken to. What were all the meetings that we had? What were all the references that were made to entrepreneurs, to other clients? It's a long list. So understand that the amount of work that's done, if you can network your LinkedIn or someone who knows you really well, that always helps. And then kind of going back to what Nat said, a typo or something like that. These are partnerships that are going to be lasting for decades. Show some care. Every detail should just be perfect. That's how conscientious you should be. And hey, send a thank you note after. This is old-fashioned, but these things still work.
Love thank you notes.
Nat, how do we get a hold of you?
Yeah, the inverse of the scenario you described with a GP knocking on the door and say, I want money, docs are due Tuesday. It's that longitudinal familiarity. It's Suster dropping by when he's going to be in Denver, in my case. It's being helpful and opening one's own network to introductions that might actually assist an LP now and then. And if you think about NPS, this is something that VCs talk about with their founders, but something I think the same concept applies to VCs and LPs. How can you stand out as a helpful, plugged in, informative partner? And you can demonstrate that with prospective LPs, and whether they come into that first close or the final close or fund 4, you can always work towards eventually consummating something just through being a good person.
And the last thing, besides showing passion when you're presenting, have some patience. It takes some time, right? And it is kind of a numbers game, but take your time, be thoughtful. Don't worry if it's going to take a little bit longer. And realize that a lot of times we'll say, not now, right? It's not a no. And every LP you meet is good for your brand because they know you're out there. It's a very difficult time to fundraise. We saw 1,409 venture growth equity funds in 2020, 2021. It was only 1,100. I guess there's not as many people raising, but it's hard to get through all that and stand out, and it takes time. And right now we're in a cycle where our LPs have overextended their capital 2 cycles. The GPs are coming back with opportunistic funds, growth on growth, and we want to support that manager because we like them. So we've put too much capital to work, and everyone's over their target. And now second cycle goes by. Okay, we'll hit the top of our target. Now we could have a potential denominator effect, and now it's the come to Jesus moment. My portfolio that most of the clients are looking at have to either downsize or kick a manager out. So you're trying to raise money in a market like that. Have patience, take your time, and thank you for your attention.
Thanks, Erik.
Thanks.
Thank you.